All right, so there was a big story that came out recently from Goldman Sachs. Goldman Sachs predicts sluggish S&P 500 growth over the next decade, warns of lower returns. So first things first, if you get value out of this video, please like and subscribe. We really appreciate that. So I wanted to kind of weigh in here and give my thoughts on this. So Goldman Sachs forecasts over the next decade the S&P 500 will yield an annualized return of 3%, significantly lower than 13% its return over the last 10 years. David Kostin, Goldman's chief U.S. equity strategist, offered this view in a note on Thursday, which is noticeably below the general consensus of 6%, indicating a marked slowdown. The 3% return forecast places future returns in the 7th percentile for 10-year returns since 1930, emphasizing the unpredictability in the future market performance. Kostin's team pointed out that the forecast range includes a probable 7% gain at the high end and 1% at the low end. So basically, my long and short of this is I think they're certainly right. The market is overvalued, and expecting returns over the next decade similar to the ones we've got over the past decade is unrealistic. But you also have to keep in mind that, at least according to this, the S&P has returned 13% over the last 10 years. I think that when you hear the average person talk about the stock market, typically they'll say that the market returns 7 to 10% per year, depending on who you hear it from. That depends on if you invest dividends. Like, there's a lot that goes into it. But usually, from what I've heard, listening to podcasts and YouTube videos, that 7 to 10% is the number that I hear. So if you take that assumption, well, let's just say 8.5, just to take the average of that, that's already like, what, 25% below the 13% average? And do we really think that the market's 25% overvalued? I certainly think that it's overvalued, but if you take the market, the historical PE, I think it's just below 22 right now, and where the 5-year average is about, I think, 19.5, and the 10-year average is like 18.5 or something along those lines. That implies that the market's, what, maybe 15 or 20% overvalued. So even if, like, for the market to underperform, if you are pricing in like 9% returns, you would have to assume that the market is at least 25% overvalued. And if you're going to assume that it's going to return 3%, that would imply that you should be paying like a 7 PE, a 6 PE. Like, we're talking about like emerging markets levels. Even that might even be a little bit over aggressive. So I think, then again, obviously I could be wrong and they could be right about this, but I think that it's absurd to suggest that it's going to return 3%. Now, again, I would say there's a 10-20% chance that some, catastrophic event happens that makes it so, yeah, the market goes basically nowhere for a decade. That certainly could happen. But is it probable? No. And that's basically my long and short of it. But if we look at the latest FactSet insights, basically they go into a lot of good detail, and you could make like a 3-hour video going over all this stuff. So I'm going to try and keep it fairly short here. But if you look at the latest numbers for Q3 2024, 79% beat earnings, which is above the 5-year average of 77% and above the 10-year average of 74%. So based on that data, it points to the fact, okay, they probably should trade at a little bit of a premium. Companies are reporting in earnings that are 6.1% above estimates, which is below the average, the 10-year average of 6.8. So factoring both of those things in together, okay, probably should be about average. So we look at revenue. Revenue is actually a little bit less than average, although you have to keep in mind that there's 16 consecutive quarters of revenue growth. I did skim through this before, but obviously I didn't read it super close. and I don't really have anything specific. I'm just kind of going over what I think is important here. 64% of S&P 500 companies reported revenue above average, which is the same as the 10-year average, exactly the same. So if you're just going based off that data, that implies that the S&P should be trading roughly on its 10-year average, which if we get into that here at the bottom, the 10-year average is a little bit over 18. So a market, having it at a little below 22, that would imply what we're probably 20% overvalued. Now again, the Goldman Sachs prediction is basically saying we're like 70% overvalued, just off the top of my head. I don't know the exact math, but so the difference between 20 and 70 is massive. Like during 2008, like I'm not old enough to remember, old enough to remember a tiny bit, but obviously I was in school and finance and stocks were not something I even understood the concept of remotely. But was it even down that much back in 2008? I think it was about 50%. I don't remember though. So basically what these guys are saying is we are talking about like a once in a century level of the stock market being overvalued. We also have to keep in mind that we're still quite significantly below the peak back in 2021, which was over 23. So we're still not even there yet. And if you look at trailing PE, we're not even close to that, right? I mean, we're not even close to that. We're at about 27.5 roughly, and back in 2021 it got to about 35. So we're not even the most the market has been overvalued just in the last 5 years. And given that information, I feel like it's pretty hard to think that the market is going to have more than like a 20% pullback. And people hear 20% and think that, it's going to be some massive crash. But no, that happens, I think, about every couple of years, maybe 3 years on average. So, yeah, like the last time it happened was back in, 2022? So that implies, we're due for a 15 or a 20, maybe 25% pullback. The problem is nobody knows when it's going to happen. We could go up another 10 or 20% from here and then pull back 20%, and we're right where we started. So nobody knows when it's going to happen. We could go down 10%, up 20%, down another 10, or down another 20, right? Like nobody knows. And the question is, what should the strategy be? And I think that depends entirely, and this is something that should go without saying, but I think it needs to be said, is it depends on number one, where you're at. Because if you're 50 or if you're 25, obviously your strategy is going to be quite a bit different. Personally, I'm always going to be fairly aggressive. Like I'm never going to be sitting in 50-50 stocks and bonds. Like it's just not going to happen for me. But that's just me. Obviously, I could be wrong about all of this. Do your own research. But if you are young, if you have more than a decade before you're even going to be thinking about retiring, to me, you're changing nothing. Like you're changing absolutely nothing. And something that good investors know and will tell you is where interest rates are at is irrelevant to whether or not you should be buying. Whether the market has a PE of 30 or 10, it should be irrelevant to whether or not you're buying. If you are strictly an index investor, yes, it certainly should come into play. But if you're a stock investor, which I overwhelmingly am, and I'm guessing most people out there watching this are, it shouldn't matter. Like it shouldn't matter at all, because the market, I wouldn't say it's irrelevant, but it's not far off being irrelevant to whether or not the company you're buying is a buy or not. Because even back in 2021, when the market was at like a significantly higher price ratio than it is right now, there were still companies that were undervalued. Like look at how many companies going back to even the peak back in 2021 are up significantly from then and still aren't egregiously overvalued. I mean, a lot of people would say, oh, NVIDIA, but NVIDIA is like way overvalued. So if we get into the sector level, just at a sector level, this is one other thing I wanted to touch on. So if we look at it, the sectors that appear to be the most overvalued is tech, right? Definitely tech. If you look at consumer discretionary, definitely a little bit overvalued, but not egregiously. Industrials definitely is overvalued, but I still think there's a lot of value in industrials. There's just some names that are like a Waste Management that is a really good company, but just trades at a really high premium because it's so consistent. There's a lot of those in industrials. They're just such steady companies, but because they're so steady, they trade at these egregious, maybe not egregious, but very high levels. If you look at the S&P, again, 21.9, 5-year average is 19.5, and the 10-year average is 18.1. Consumer staples, definitely a little bit overvalued. Materials is overvalued. Real estate doesn't actually even show up here, at least with a 10-year average, but it's almost right on the 5-year. Real estate, yeah, that's the one sector that I think definitely is not really overvalued, but it's definitely not undervalued. Prior to the 3-4 months ago, I think you could have argued that it was undervalued, but I think that's definitely not the case anymore. Healthcare actually is below. Healthcare is one of the few sectors to where it is below the 5-year and the 10-year. Healthcare, I think you need to be really careful because some of the biotech names I think are very risky. I think that there's a lot of really risky companies in the healthcare sector, some of the pharmaceutical names. So you have to be really careful, but I think there is some hidden gems in there. They're just few and far between. Utilities, I don't think I own one utility company because I think there's just better options. You're buying utilities primarily because of the dividend, and when rates are high, that's pretty much why utilities are trading at a discount because, up until very recently, rates were low, and that's why people bought so many utilities. Communication services is also below. There's not a lot of communication services companies that I like. I know some people would disagree with that, but that's just my personal opinion. Financials is also below. And I think that there's a lot of good financials names out there, right? There's some banks that I like. Insurance companies are one of my favorite industries right now. There's a lot of those insurance companies that are super steady companies, but I mean they're beating the S&P, but they have like a 12 PE. So there's a lot of good insurance companies out there. I'm not going to say any off the top of my head. You can go look back at some of my previous videos. I've made videos on several of them. And then we have energy. Energy is actually below as well. So, and I think that there's definitely some energy names that are at a discount right now. That is basically the market, right? Basically, the long and short of things is don't expect the S&P to return 13% over the next 10 years. I wouldn't even expect 10. If I had like a gun to my head, you have to make a prediction and be right within 10%. I would guess probably between 7 and 8% over the next decade, which is probably a tiny bit below the average. So obviously I could be wrong about that. I'd love to hear other people's thoughts on the topic, but that's just what I think. And the reason that I say that also is to some degree, like average Joe investing is also something that's became a lot easier over the last decade. Like how many average Joes 20 years ago were buying and selling their own stocks, and could do it as easy as you can do it now. Like obviously I don't remember, but given the infancy of the internet and whatnot, and smartphones weren't even a thing, right? You can do it I literally bought and sold a couple stocks literally sitting on the beach on holidays last year. Like that's how easy it is to do. So given that information, I think the average Joe, like just that extra money from the average Joe, Again, I'm just going off gut feeling here. I feel like that information probably would give the market an extra 5 or 10%. So an S&P around an S&P PE around 19 to 20, that's probably where I would say is about fair value, which implies that we're 10 or 15% overvalued right now. That's what I think. Now, again, a lot of people are going to take that as, oh, I should sell stocks, which, again, comes down entirely to, do you need that money in the very near future, within the next few years, maybe 5 years? If that's a yes, that's something you probably want to think about doing. But again, consult a professional. I'm no expert, but just my opinion. If you're a long-term investor, you're not even thinking about retiring in at least for 10 years. In my opinion, you have no reason to sell. If you have a ton of Nvidia, I probably would be selling and reallocating, because I think that's one thing I definitely do believe in. I don't believe in having more than 5 or maybe 10% in one stock. I definitely do agree with that. Now, again, a lot of people disagree with that and say, oh, if the goal is to get rich, but if the goal is to get rich over the short term, yeah, but if the goal is to get rich over the long term, you don't need to hit it big on one stock. You just need to be consistent. Getting into my video from yesterday, you don't need to hit it big. You just need to be consistent and patient. So anyway, I'm going to leave it there. I've talked for long enough. Like I mentioned off the start there, if you got value, please like, subscribe, comment, all that good stuff, and stay tuned for more.